All right, today we're going to unpack a pretty stunning pivot from one of Wall Street's biggest giants. For 8 years, this bank told you crypto was dangerous. And now they've done a complete 180. Let's get into why. First things first, let's talk about scale. This number, $6.4 trillion, that's how much client money is managed by Bitcoin's newest and maybe most unlikely backer, Morgan Stanley. Just keep that colossal figure in your head for a second. Because for the better part of a decade, this was the official message coming from the firm with all that money. They literally told their 15,000 financial advisors that Bitcoin was just off limits for regular investors. So what happened? Seriously, how do you go from too dangerous to diving in head first? This reversal is honestly one of the biggest crypto stories of the year. And here is the big move. See, they didn't just approve Bitcoin, they filed paperwork to launch their very own product. This means they're shifting from just recommending it to manufacturing and selling their own branded version directly to their 19 million clients. Now, to really get how significant this is, we have to look back. Their history with crypto has been, one of restriction and a whole lot of skepticism. This reversal didn't happen overnight. I mean, look at this. In 2018, it was a hard no, period. By 2024, they cracked the door open a little, but only for the very wealthy. Then, in late 2025, the floodgates opened to pretty much everyone. And just a few months later, boom, they're not just allowing it, they're creating their own. The pattern is crystal clear. So what is the real reason for this complete change of heart? Let's be honest, this has very little to do with a change in philosophy and, well, everything to do with following the money. This really is the central question, isn't it? Why would an institution that spent 8 years warning you about an asset suddenly race to package it up and sell it to you? Well, the answer is all in the business model. Look, it all boils down to a crucial distinction. Before, when one of their advisors recommended, say, a BlackRock ETF, BlackRock got the fees. Morgan Stanley was just the distributor. By launching their own ETF, they become the manufacturer. And now, they keep every single dollar of those fees. And the size of that prize is just enormous. They were watching from the sidelines as the spot Bitcoin ETF market swelled to over $123 billion. Their competitors, like BlackRock, were just racking up tens of billions in assets. Morgan Stanley realized they were leaving a massive revenue stream on the table. Okay, so the money was clearly there. We get that. But what was the tipping point? Why was now the right time to finally make the move? The answer is actually pretty simple. The risk basically disappeared. The whole regulatory scene in the US shifted, the SEC gave the green light for these exact products, and federal regulators cleared banks to handle crypto. And critically, pioneers like BlackRock took all the initial arrows and proved that the model was a blockbuster success. It's a classic Wall Street playbook. Morgan Stanley just waited. They let the pioneers test the waters, absorb the early hits, build the entire infrastructure, and once the path was clear and the profit was undeniable, they walked right in to capture the territory. So this isn't just about one bank's decision. This is about what happens when that bank turns on its massive distribution network. Let's look at the potential impact on the market because it's huge. So check this out, 4%. This is the official guidance. Morgan Stanley's own Global Investment Committee is now recommending up to a 4% allocation to crypto for its clients. So what does that 4% recommendation actually mean in practice? Well, if their clients follow that advice with their $6.4 trillion in assets, that's a potential inflow of $256 billion into the crypto market. And to put that number into perspective, this is the total amount of money currently held in all spot Bitcoin ETFs combined. Yeah, let that sink in for a moment. The potential demand from just one bank's client base is more than double the size of the entire existing spot Bitcoin ETF market. We're talking about a staggering amount of new capital just waiting on the sidelines. But the story doesn't even end with Bitcoin. On the very same day, Morgan Stanley also filed for a Solana ETF. And this one comes with a game-changing twist. That twist is something called staking. The proposed Solana fund will actually stake its holdings, which means the fund itself will earn yield from the network. And those rewards, they flow back to the investors. So yeah, Morgan Stanley is about to offer a Wall Street product that generates passive income from an asset they called too dangerous just a couple of years ago. So what's the big takeaway here? This was never some ideological battle. Morgan Stanley didn't suddenly have a big revelation about decentralized finance. No, they just waited until there was a clear, safe, and regulated way to collect fees from massive client demand. They believed in fees all along. So let's end with this thought. Morgan Stanley didn't just change its policy. It completely changed its business model. They've now paved the way. So the real question is, what happens to the market when every other bank on Wall Street decides to follow them?